Hi, myself Mohammed Abdul NASEER, a student of Data Analytics stream, and my student ID is 2837124. We have given with a scenario for functionals enterprises case study, and in the upcoming slides we will see some of the important aspects. So let's get started. So coming to the contents of this presentation, so we will see brief introduction, important aspects of the pro forma income statement, income aspects of the working capital analysis, important aspects of the free cash flows, recommendations, and the conclusion. So coming to the brief introduction. So in this capital budgeting scenario involving Princel's Enterprises project, the company is considering an investment opportunity that spans for 5 years. This project involves equipment purchase, capital working capital investment, sales projections. The financial evaluation includes income statements, working capital analysis, and free cash flow calculations over the investment's duration. So the primary objective is to assess the project's financial viability using NPV. So here NPV stands for net present value, benefit cost ratio, and IRR, that is internal rate of return. These metrics offer insights into the project potential profitability, comparing the initial investment to expected returns, and determining the investment meets Princeton Enterprises required rate of return. So this scenario showcases the company's meticulous analysis of the investment financial aspects, aiming to determine whether they are pursuing a screen guard project aligns with its financial goals and profitability expectations. So the calculations and financial metrics provide a quantitative basis for evaluating the project's feasibility and potential contribution to the company's financial growth. So coming to the important aspects of the performer income statement, the performer income statement provides a forward-looking view of the company for expected financial performance. So in this case, analyzing the Fresnel's Enterprises Screen Card project, we see the following things like this: sales projections, cost of goods sold, selling and administrative expenses, EBIT, and net income. So coming to the sales projections, the sales forecast outlines anticipated revenue over 5 years. It shows a steady growth until 3 years and followed by a little bit decline. This trend may reflect market saturation or changing consumer preferences. So the consumer preferences might change over the period of time. They can't be constant for all 5 years. So there might be some changes in a consumer's perspective as well. Next, coming to the cost of goods sold, COGS. It reflects the direct costs associated with the production. The percentage seems stable, but the absolute figures might be high compared to sales, affecting the profitability. Selling and administrative expense. Consistent over the years. It is consistent over the period of 5 years, a positive sign for cost control. However, these expenses could be analyzed further for potential optimization. And the next is EBIT and net income. So coming to the EBIT and net income, it indicates profitability before taxes, whereas net income shows bottom line profitability. Negative figures in the initial years suggest losses, potentially impacting investor confidence. So the next is depreciation and tax and earnings. So depreciation, as we all know, it is consistent over the years due to straight line depreciation. This could benefit tax implications but may reflect something other than the actual economic lives of the assets. Tax and earnings. Negative earnings in the first year reflect tax benefits but raise concerns about long-term profitability. So after analyzing all these numbers, the some of the strengths include cost stability and a positive trend in sales. However, then weaknesses lie in initial losses, declining sales in the later years, and profitability, potentially high production cost, which might affect profitability. The consistent selling expenses are favorable, but the venture needs to be addressed declining sales and negative earnings to ensure sustainable growth. Another important aspects of the working capital analysis are after seeing the for given worksheet and the numbers. The analysis shows that working capital need is starting at $0. It increases annually, signifying the requirement for additional funds to support operations. There will be various operations like in the financial institution. So if it is an enterprise, there will be a lot of operations like cost, production, and requirement gathering, everything. So working capital change shows fluctuations in working capital requirements. A positive figure indicates increased working capital needs, while a negative reflects decreased requirements. So recovery of working capital, it's a positive value in the year 5 suggests reducing the need for working capital, possibly from liquidating excess assets or efficient management of the funds. So by analyzing the numbers, we come to the following two things, that is the strengths and the weakness. One of the strengths that I'm highlighting in the presentation is early investment. The absence of initial working capital investments implies efficient use of existing resources or low initial operational requirements. And some of the weaknesses are increasing needs, fluctuating needs, large investment in the year 5. So the increasing working capital in requirements indicates expanding operations of sales, which could strain liquidity if not appropriately managed. Fluctuating needs, the fluctuation simply implies instability or changing operational demands, possibly due to inefficiencies or inconsistent sales. And the third one is large investment in the fifth year, the substantial $200,000 investment in the fifth year indicates potential scalability and substantial financial commitment, or there might be a chance of risk. These factors of concern revolve around the increasing and fluctuating working capital needs. Fresnel enterprises must evaluate the reasons behind these variations and develop strategies to manage working capital efficiently. So it is crucial to balance growth and liquidity to ensure operational stability and financial growth. Important aspects of the free cash flow are what first we will understand what is free cash flow. So FCF is a measure of company's financial performance that represents the cash generated by the company's operations after accounting for capital expenditures. So it is an essential measure of a company ability to generate cash and pay dividends to shareholders. So this table shows the free cash flows for each year of the project along with the net NPV and benefit cost ratio and IRR, internal rate of return. So here we start with the year 0, following with the first year, second year, third year, fourth year, and fifth year. So we are seeing that there is a significant decrease from the year 1 free cash flow to the year 5. There is an increase. NPV is also increasing from $16,982 to 152, and then followed by 100,000 more dollars, that is 252, and again 100 253, and next to 298. So a BCR, the benefit cost ratio, is steadily increasing starting from 0.023 to 4.44, and IRR similarly. So coming to the analysis of these free cash flows, some important aspects are interpretation and favorability. What are some of the interpretations after seeing this table? So NPV reflects the total present value of the FCFs. A positive NPV indicates profitability and potential value creation, suggesting the venture could generate returns above the required rate. So this is the favorability, and this can be interpreted from the above given data. And similarly, the BCR, the benefit cost ratio, indicates that only 33.7% of present value returns are generated for every dollar investment. This low ratio implies a substantial shortfall compared to the initial investment. So there might be a shortfall in this. But coming to the rate of return, internal rate of return, it exceeds 21.5% the required rate of return. So the required rate of return is 12%, but we are exceeding in this thing. This suggests that the project may yield higher returns than the cost of capital, indicating its potential viability. So analysis of this are NPV and IRR are favorable and BCRR is unfavorable, because we all know that there is a shortfall in BCR, and NPV and internal rate of returns are exceeding to the threshold value or the interpreted value. Hence, while NPV and IRR picture a potential profitability and returns, the low BCR raises the concerns about the venture's efficiency in generating returns related to the initial investment. It indicates it indicates a potential risk not fully recovering the investment capital. Further evaluation and risk mitigation strategies may be necessary to address this BCR concerns. Some of the recommendations after following all this analysis are positive aspects are NPV and IRR. We all know that NPV is and IRR is exceeding to its threshold value, like $227,000 for NPV, net present value. It is a positive, and IRR is 21.5%. It indicates profitability and returns above the required rate, that is 12%. Projections are projections exhibit steady growth over the first 3 years, showcasing market potential. Working capital. The venture maintains a positive net working capital over the years, ensuring adequate liquidity to cover short-term obligations. And some of the concerns and risks related are the BCR. We all know that. So benefit cost ratio of 0.337 reveals that each dollar invested only about 33.7 cents in present value returns are generated. So this indicating potential inefficiency in generating returns compared to the initial investment. So negative initial years, the initial years shows a substantial negative free cash flow, demanding more extended period to recover the initial investment. So coming to the recommendations and mitigation strategies, proceeding with the caution. Despite the positive NPV and IRR, the low BCR indicates a substantial risk in terms of return efficiency. Considering a cautious approach and further evaluation, risk mitigation. Conduct thorough market analysis and reassess the cost structure, especially the production cost, to reduce the expenses and improve the benefit cost balance. Long-term strategy is by considering the project duration beyond the provided 5 years to ensure better recovery of the initial investment, considering the project's perpetual nature. So coming to the conclusion of this the whole scenario, we can say that it has presents potential profitability. The low BCR raises concerns about efficiency in generating returns related to the investment, but proceeding cautiously with strategic adjustments and a more extended project timeline could mitigate risk and enhance the venture's overall viability. This recommendation is grounded in the analysis, utilizing the positive aspects to justify profitability while addressing the identified risks to maintain a prudent approach to the investment decision. And last, I will conclude my presentation with a small quote. Prices are easy to understand, and it is easy to isolate or pick assets based on prices. Understanding the businesses and analyzing the risks is complex. Thank you.